Hey, good morning, everybody. Welcome into the live feed here on Facebook. This is the Revolved Realty Real Talk show. I called it Real Chat.
Not to be confused with the Real Chat show.
Which one is it? It's Real Talk,
It's
right?
definitely Real Talk.
All right. For some reason, I was calling it Real Chat.
What's the difference in talking and chatting?
I think chatting you do when you're with your girlfriend.
No, so let me tell you, I asked that question because I knew the answer. Mom, if you're out there watching, but she's not, but when my mom used to say, we need to chat,
that was not good.
I'm talking about trouble. So
Yeah.
For me, when you said Real Chat, I'm like, uh-oh.
But what happens
An
when
appraisal must have come in low. Everybody's upset.
But when your wife says, Zach, we have to talk.
Yeah, but that's also not good. So I don't know what we're going to call this show.
Well, we're gonna go with real talk for the moment. But
Decatur, Alabama.
Yeah. Hey, welcome in. Do us a favor if you are watching, even if you're not watching, share the show. Zach had to take an emergency call. It must have been the president. So we have a good show for you today. We are graced by the presence of Stephen Allen with the mortgage firm. How are you?
Doing awesome. How are you?
I'm doing good. Stephen is
Awesome.
a buddy and one of our local experts in when it comes to mortgages. And one of the things we want to do on this show is start talking more about the process of buying a home. And of course, the first step for a lot of folks is in the mortgage stage.
Right.
And I hear this quite a bit. What is the process? What do we have to do?
Really good.
Hang on 1 second because we're going live. I'm going to close this door because Zach is out there on the phone. Sing something. Welcome to live video. Sorry about that. This is the way it works. When you're a realtor and you get a phone call, you got to take it. So first off, tell us a little bit about yourself and about the mortgage firm.
Mortgage firm has been in business since 1995. Really, the main goal of what the mortgage firm is meant to do, and it's meant to do really two things. It's been built around how does real estate and the agents actually want to be communicated with. That really starts with number one, communication. If you don't have the communication part of it, you don't have anything. And so really the mortgage firm is built on communication and making the process simple. And I'll be happy to talk more about that.
How long has the company been in business?
95.
Okay. So, and I met your CEO, very nice guy based out of Florida.
Mm-hmm. Orlando, Florida.
Okay. And how long has the branch been here local?
Locally, we've been there about we're coming up on a year now. So we're excited to be a part of this community. We're located down in downtown Huntsville in the Linear Ford building.
And you've been in the business how long?
Going on in the finance business. I've been in finance about 12 years. Okay. I've been in the mortgage business for a better part of those times.
Okay. And how is the mortgage business right now?
It is on fire.
Yeah. Somebody's got to finance all these houses. Yeah.
By the way, I'm bilingual.
Well, we should
it's
chat.
in fuego.
We should chat.
I'm going to translate for you. The mortgage business is in fuego.
Absolutely.
In fuego means
on fire.
On fire. Bueno, very good. Hey,
bueno.
You know what? We should do a Spanish version of the show.
I got that.
We did. Ammon.
We're going to go over and
Chelsea McKinney's husband is fluent. He did mission trips in South America for several years.
Honduras.
Go to a Mexican restaurant with Ammon McKinney. It's because they love him because he's like this 6'6", good-looking blonde guy who speaks fluent Spanish. But anyway, so let's get back on track.
Sorry about
that. Just play with your phone and let us do the show.
I'm just trying to share the live.
When you figure out how to do that, let me know.
Well, you didn't let me bring my computer.
Yeah. So, all right. So the mortgage business is hot. Someone has to finance these houses. Let's talk about the process because one of the questions that I get quite a bit from folks that have never bought a home is they don't know how the process works. They don't know where to start. I have people send me, links to $500,000 houses saying, this is the house I want. How do I get it? And they can't buy it. And they simply don't understand the process. So walk us through when someone like a realtor like me calls you up and says, hey, Stephen, I've got a client here who is interested in a home. They've never bought a home before. They don't know what the process is. What do you do?
The quickest way to upset a realtor is be out shopping for a home and not even be pre-approved for it.
This is so true.
That's yeah. I mean, I've seen it time and time again. Someone comes to me, has a property, and they've never even looked into if it's something they can get approved for. So that's step one. You always want to get either pre-qualified. There's a difference between these two.
Well, let's talk about that. Let's take it a step at a time. There's pre-qualification, pre-approval, and underwriting. What is pre-qualification?
I will simplify it.
That's the first step?
Yeah, pre-qualification is basically the simplest way to put it. It is the process of getting approved or pre-qualified for a mortgage based on what you state.
State over the phone or in person?
Correct. Basically, you put on your application, you might make $5,000 a month.
Right.
And you put on your application, you might have such and such amount of dollar in debt. So what we do is we can take that information and we can pre-qualify you based on what you've told us. We can get you approved.
Now, is there any real, people can tell you anything.
Right.
They can put anything on a form. At that point in the game, are you actually doing anything to make sure what they're telling you is true? Or is it just kind of okay, we're going to take you at your word. Here's what you qualify.
I don't issue paper based on just their word.
Okay.
Because what that does is that'll eventually get you into a situation where your contract's falling through because financing's falling through.
Yeah.
And so what you have to do is you have to take it a step further. In order to really have your due diligence in that process, you have to get a pre-approval. And that involves getting documentation, starting to verify what they have told you, and doing, in essence, a pre-underwrite on that file before you get them a letter so they can go out shopping.
So the pre-qual part is they call you up and say, okay, here's how much money I make a year. Here's my debt. Can you pre-qualify?
Right.
And then you will issue a pre-qual letter that just basically says on the surface, these folks look like they're going to be able to buy X.
Absolutely.
All right. So then the next step is pre-approval.
Pre-approval, that involves gathering documentation. A lot of companies do it differently. I'll tell you how we do it. We base our gathering of documents based on something that's called Desktop Underwriter and Loan Prospector. Those are the two programs that are issued for automated underwriting through Fannie Mae and Freddie Mac, which are the two largest insurers of conventional mortgages and the processing of actual loan applications. So in those types of scenarios, what we run through their automated underwriting system, or in our business, we refer to it as AUS. In that system, it will then tell us what documentation we need in order to verify that that buyer is able to buy.
Okay.
If I can get those documents, that is in essence a pre-automated underwritten file.
So that means
that's a mouthful.
It is.
Yeah.
Now underwriting is where you really dig in.
Yes.
And Zach and I both know we've seen deals fall apart in underwriting.
Yeah, that's the invasive part of the process. That's where things get real.
That's where you have to open your kimono and turn your head and cough. That's what we say in the business. Well, it is, because basically you're going to dive into, you're going to verify and prove that they do make X number of dollars. You're going to look at things like, where does the down payment come from? What are the rules there? Because a lot of times, especially younger couples, mom and dad might help them out, or they might have other pockets of money. What are some of the rules that govern where that down payment can come from?
In essence, the down payment has to be either borrower-based. It can't be the sellers paying their down payment.
Okay.
That's pretty much one of the biggest things that can't happen. Other than that, an employer can gift it to them. Gift letters are common.
Gift letter.
The gift letters are very common. That's how you get around a lot of things there.
Is there a limit on that?
The limit's based on the program. So depending on what loan program you do, there are different limits to what can be gifted in essence. But for the most part, if someone's looking to do an FHA mortgage, they can receive a gift of all of that down payment.
Really? Okay, and that gift can come from anyone?
Gift typically has to be somebody family-related, friends. If they have a due interest, I mean, it's always going to come up. You would have to have a letter of explanation, typically explaining who's given this. It gets pretty invasive even with a gift letter. You have to not only
There's nothing about the process that isn't invasive. And to be clear, like, that's okay, because if you look back at the history in the mortgage business, we've been down that road where you don't verify, and before you know it, we have the mid-2000s all over again, because we were lending money to, I wrote a letter, I'd like $1 million, and I make $1 million. And like, sounds good to me.
Yeah.
Like, give it to them.
That's back during the day when we didn't collect any documents.
That's right.
Saved income loans.
So you have cocktail waitresses who own multiple $1 million houses.
That's right. And I look at it kind of like I look at the TSA, and this might be a reach for some people, but like, it's very uncomfortable to go through an airport, go through security, and you're like, look, I'm not going to do anything crazy. The reality is somebody might.
Absolutely.
And so for our safety, we have to go through TSA. Right. Same concept with the mortgage process is, look, it's uncomfortable, it's invasive, but it's for your protection, it's for the seller's protection, it's for the bank's protection, it's for everybody. It just really and truly, it's invasive, but there's a reason for it.
Absolutely.
And I think people need to understand that, because it gets frustrating, but so does the line at the TSA. But it's so I don't get blown up on a plane.
Yeah, well, one of the main things with it, I mean, it's ability to repay. Do you have that ability to repay this largest asset that you're investing in? And so really the biggest thing that I think people don't realize is we pre-approve you based on your gross income. Well, none of us get our gross income.
You don't look at the other payments they have or the debt load.
We look at their debt, but what we don't look at is how much is Uncle Sam taking out.
Yeah.
How much are you paying out in your benefits?
Mm-hmm.
How much money are you paying out to all those secondary policies that you may have, insurance policies being deducted? How much are you putting into your 401k? It's not based on that.
Right.
So we're giving you, in some cases, a maximum of 55% debt to income ratio. We're lending you up to 55% of what you gross in your income.
But what if they can't pay that back?
See, that's the part.
And now let me tell you a really quick story. One of my early clients was a young man. Excuse me. He had been pre-qualified for like $200,000. Well, when I sat down with him and we looked at what his bills were for the month, he couldn't afford anything near that when it came to payment. So what do you do counseling with these folks, or is that, whose responsibility is it to sit down with a client and say, okay, you qualify for 200, but you probably can only afford payments on X. Do you do that kind of counseling?
Absolutely. If you don't, you're doing your client a disservice.
Right.
Because I can approve somebody for a lot of a home that they do not have any business owning.
And they'll end up losing that.
They absolutely will. That's where we're getting our foreclosures from. And you get a lot of that because what you have is people are overextending themselves based on approvals that are pretty liberal.
Right.
But they just don't qualify. So we are more than just issuing paper on approvals. If they get approved, we need to counsel our people to make sure that that asset is a blessing rather than a curse to them.
When I had this conversation last night. It's funny we're talking about this. A good friend of mine, young couple, bought a starter home. They did some great updating, little things they could do on their own. They've increased the value and they're ready to move in to their next home, the home where they're probably going to bring home their first kid. That type of stuff. And so what I come from the investment world first, not retail real estate. And so what people need to understand is your home, by and large for the population out there, is the largest single investment you'll ever make. Right. I mean, if you've got a $250,000 house, do you have one other investment in your life that values to? No, you don't. The reality is you don't. And so when you stop looking at it as, well, this is my home where I want to love everything about it. Well, you can love everything about the money you're going to put in your pocket if you buy your house correctly. If you buy what you can afford, if you buy with equity, and it's just, that's our job. Yeah. Our job is not to, I tell people all the time, it's not to sell a house. My job is not to sell homes. My job is to protect my clients and find a home that suits their needs, but also their budget. It suits their life, because we've all overbought in some capacity, whether it's a house or a car or whatever.
Yeah. And
the reality is, if it's not tenable long term, it doesn't help anybody. And so drop that budget that you're shopping with for your house. Yeah. Let's get realistic. Let's find a house where maybe it's not as updated as you'd like, but over the course of 5 years, you can invest some time and some money, create some equity, grow your value, and then turn around like the house I looked at last night. They invested $30,000 over 5 years and did some work. When they sold it, they'd be $120,000 in the plus. I'll give you $30,000 all day if you'll give me $130 in 5 years. Yeah. All day.
I think one of the good points that you make is we kind of live in this society where people, they want to know how much it's going to cost a month, except when it comes to their house. Yeah. If you go out and buy a car, they sell cars based on your monthly payment of. Okay, people don't think, well, geez, this is going to end up costing me $50,000 for this little Hyundai. But when it comes to houses and pre-qual, we tell them, okay, here's this gigantic number that you can afford. I think there should be a caveat there that says you can't afford it if you didn't have all these extra bills. Well, so I think Zach makes a good point. You've got to work on the client's behalf to make sure they understand. Just because they qualify for that doesn't mean
it's awkward.
It is
and it's uncomfortable.
It is, but it's necessary.
Well, people don't, the mortgage process, why we're talking about this morning is because it's this gorilla in the corner that, like, it's scary, it's complicated. Well, let's talk about debt service cost, because that's the biggest and most overlooked piece of this whole puzzle. Like you said, you buy a car based on your monthly payment. Mm-hmm. Let's look at the debt service over 30 years or 15 years or whatever of getting your payment where you need it. What's your debt service cost? Your principal, your interest. If you're buying a house at $150,000, but at the end of your 30-year mortgage, you paid $320 for it, you didn't pay $150,000 for the house. Right. And people need to understand, they need to be educated to look at the 30-year picture, not the 30-day picture. Yeah. The 30-day picture is great and it fits your budget, and I get that, but you put 3% down because you don't have 10% of a bigger house, you've got PMI, you've got all these other things that roll into it, and now all of a sudden your house cost you twice what it should have because you bought that extra bedroom or that tray ceiling or that wainscoting that you could have gone to Lowe's and bought and put on yourself.
Yeah. So, all right, let's get back to the process. So the pre-qualification really is just a conversation. Here's how much we make. The pre-approval, you take it a step further. Now, the underwriting process is really what you guys call, it is invasive because you have to provide a lot of documentation. It's a pain in the butt. Even to refi is a pain in the butt, but it's necessary because all the bank cares about is getting their money back. They don't want your house. They don't want to foreclose. They just want you to pay the loan back. And that's why underwriting has to be, it is the real estate equivalent of a colonoscopy without anesthesia sometimes, because they really do the amount of paperwork. But
thank you for that.
You're asking them to loan you a couple of $100,000. Yes. They are within their rights to be thorough. Now, as a broker, you are working with a third-party lender, correct? You guys don't do your own lending.
We do everything in-house.
Okay.
So we are
so your underwriters are in-house?
Correct. We are a direct lender. We do have loans that we can broker out. And really what a direct lender is we are the ones that process the file, we underwrite the file, and we're actually in charge of funding the file.
So you do everything?
We do everything. Okay. It's after that loan is funded that we then send it out and investors purchase that.
Gotcha. Okay.
So we are in essence a direct lender. We can sell direct to Fannie Mae and Freddie Mac, which are the two biggest purchasers of mortgages. But that's important to look for, to really know what the difference is in the two. Because if you go to a bank, what you're dealing with is what those bank products are.
Right.
If you're working with a broker, you're working with, or even a wholesale lender for that matter, that wholesale lender does not have in-house underwriting. They then create that file and they ship it out to another wholesaler who actually underwrites and funds the file. So they're not responsible for anything on that file.
Right.
Then you have direct lenders, which is what I am. The direct lender aspect takes charge of the whole process from start to finish, and we truly know what's going on with your loan until the day that it actually will close.
Okay. Well, I want to talk about the product. Right. You mentioned products, and so that's something that's come up a lot recently for me, because talk to people about, like, you have your banks, which they have a certain, but a lot of brokers have to have banks because there are bank specific products.
Sure.
So there's not just one mortgage, and that's what I want to like. There are options for you based on your goals, based on your needs, based on if you want to get a little extra money to renovate a house, because you can show there are different, and not everybody offers every type of product.
You're correct.
And so tell us a little bit about the products, how that selection, what the consumer needs to know about how to shop effectively for the right product for them, because It's not all the same.
I'd say it starts with being transparent as a person out shopping for a home. When your lender asks the question, tell me about what you're looking to do, it's a very loaded question, because what we're taking with that is we're trying to figure out what direction are we going. Because as you mentioned, there are multiple programs. FHA has a program that's called the 203K program. That's a fantastic program that can be used for doing upgrades to a home, doing minor renovations, putting a new roof on it, doing things that are necessary in a purchase.
That improve the value.
Absolutely.
Got to improve the value.
Absolutely.
That's the kicker.
You even have it on the conventional side. You have the home style renovations. You have all of these other renovation style loans that are available for you. So that's step one. Are you looking to buy a home and be a fixer-upper? Are you looking to get a move-in ready home? That might be more your traditional USDA type loans, or otherwise known as rural development loans. FHA loans, you've got your traditional conventional loans, your Veterans Administration loans, the VA.
And they all accomplish something very different.
They definitely do. They're all extremely different depending on what it is. So I think that's one of the biggest things. I just recently had a client that I did my interview with, and I asked them all about what they were looking to do. Well, I was actually halfway through the process, and I learned that they are VA eligible. Totally was able to save them $20,000.
Sure.
So it's extremely important to be transparent with your lenders. And as lenders, it's important that we find out what's best for our buyers, because like you say, there's a ton of programs available.
Well, it speaks to a basic truth in the type of business that we're in. We're in a relationship business. Call it what it is. People do business who they know, love, and trust. When you're shopping for a realtor, when you're shopping for a loan, when you're shopping for anything to insurance, you want to find someone who you feel comfortable being transparent with, being someone who's willing to listen, someone who's willing, because that person is simply trying to, if they're good at their job, do what's best for you, because we know more than the average consumer does. And our job is to educate them, not sell them. And so that's something that you guys have to take. We have to do a better job of teaching, educating, but consumers have to understand that. I can't tell you how many times people just go to the first lender that their real estate agent or whomever kicks over to them. And it's like, I'm never going to give just one. If a client asks me, who should I? Well, here's 3 people I trust. But I know my client probably better than you do at this point. So I know who's got what because I'm somewhat educated. I'm going to point them in the right direction. And then I tell them to call all 3 of them. Talk to them, get a feeling, personalities. Does this person care for you? And look, they might catch you on a bad day and you might be busy. And they might be like, that guy he's not interested in me. And that's part of it. Sometimes that happens. But yeah, it's all about the consumer. And that's what I love about this business. We get to educate. Most people are terrified of all this stuff. Let's talk about down payment, because that's a ugly elephant in the room. There's not a lot of people that have the cash that they need to go out and put 20% down and get conventional. And then we're terrified because PMI is going to, So what are the options currently in the products that you have available in relationship to down payment versus PMI versus, because that changes your loan cost over the course of 30 years. So talk about that a little bit, because I think it's important to understand that.
Define PMI first.
Private mortgage insurance. Private mortgage insurance is something that come out shortly after the crash of the market. What that does is it's nothing more than insurance that affects and protects the lender or the person that's servicing that mortgage. And it doesn't really do anything except guarantees them that if you default on your loan, that lender is going to be reimbursed.
And the borrower has to pay those premiums.
Absolutely.
Okay.
In a conventional situation, which a conventional loan by historic definition has always been what most people know it as, 20% down loans. In that situation, if you're coming into the purchase and have 20% down, you don't have private mortgage insurance. But conventional loans can actually be done right now with as little as 3% down. So there are available conventional loans right now. For instance, one that specifically comes to mind is Fannie Mae has a program called the Home Ready program. In that one situation, you have Home Ready has a 3% down payment. On top of the 3% down, you have a reduced private mortgage insurance payment, which that allows you to save money.
Yeah, and that's one of the things. If you've got the 20%, you don't have to pay the PMI typically. But you also, if you get to a point where you have paid the mortgage down, you can request the PMI.
In the conventional loan program, yes. Once you reach that 20, or actually it's 78%, but once you reach 78% after you've got that much equity position in that home, in conventional, you can have that removed.
Okay.
After 2011, FHA eliminated the ability to drop your private mortgage insurance. And now in an FHA program, you have private mortgage insurance until the day you pay it.
Okay. All right, now talk down payments, as Zach was asking about. Yeah.
Down payments, it can be anywhere, like I say, as little as 3%. There's also even programs that Alabama Housing and Finance Authority offers, which are your state bond programs through the state of Alabama. If the borrower invests 3%, or I'm sorry, if the borrower invests 0.5% down, then they can actually get 3% financed over a period of 10 years from the state. So that's another great program that pairs well with the FHA. Then you have your USDA, which is 100% no down payment program. A lot of your builders that you find that are building outside city limits, you'll see all having 100% down or 100% financing available on this property. That's where they get it, because what they're doing is they're building in a USDA serviceable area.
So for the record, let me just clear that up.
Okay.
I want to state that very plainly. The builder is not giving you 100% financing.
Correct.
The builder is using a government program to offer you something by building in an area
Absolutely.
Correct me if I'm wrong, Limestone County in its entirety is USDA qualified, isn't it?
It can change at any time, but for the most part, yes, you're not going to find many areas in Limestone County that are not USDA eligible.
So if you're out there and you're listening and you're looking at building or buying in Limestone County, understand USDA is available to you. That's 100%, say it again, 100% down, financing.
100% financing, no money down.
Something to look at in every situation.
Yes.
I mean, because again, cash is king, right? And that's typically your hang up in a lot of these deals is I don't have the cash.
Yeah.
I'm working on one right now. Cash is the biggest. We're willing to overpay for the house, but we need the closing costs covered.
Yeah, we're getting at it a lot. I've done 2 of those deals last week. So talk really quickly in the time we've got left about why deals fall through. Why is it that we get all the way to underwriting?
I'm just kidding.
Yeah,
kidding.
God love the appraiser. Somebody has to. Why do deals fall apart typically on the lending side, especially in the underwriting?
A lot goes into underwriting a file. You have income, you have job stability. How long have they been on their job? Some of the biggest things that I see is at the last minute, homeowners insurance changes. So for instance, a lot of people don't request that their buyers go get a homeowners insurance quote up until the end.
Right.
We as lenders do typically an area average, or unfortunately we guesstimate in some cases what we guesstimate that insurance cost to be. One scenario I'm working on now, I guesstimated based on my assumptions of the area, $175 monthly insurance. His insurance, when it come back at the very end, ended up being $435 a month. That's going to kill the deal.
Now, why is that?
A lot goes into the insurance scores.
Yeah.
That would probably be a better question for insurance, but typically,
well, then that would require us getting an insurance guy in here.
Yeah, they're credit driven.
We can make that happen.
How many of those? Yeah. Okay, so really it comes down to the payment. For whatever reason, a lot of times the payment that's predicted is not the payment that comes out, and that can kill you.
Do your due diligence up front as a lender. Keep your lenders in check. Even if you're out there buying, check in the process. See if they've locked your loan, because that can make a difference. A lot of lenders out there are competitive right now, and they're willing to put on paper that you're going to get a 4.25%. Well, the reality is that right now rates are in a increasing rate environment. So lock your loan.
What does that mean?
That means that your interest rate when you lock your loan will not change before you close.
The lender is giving you the amount of your interest rate that is going to apply regardless of whether the rates go up or down. You're locking it
It's the Who Wants to Be a Millionaire equivalent of that's my final answer.
Yeah, got it. Gotcha.
You're locking it down. You're saying, I want this rate. And what you're in essence doing is you're saying that this is the rate I want to be at. If it goes down, no, you don't really take advantage of the downturn in rates. If it goes up, you definitely save and don't have to pay more.
Yeah.
So,
but the odds are at this point in the market,
it's going to go up.
It's not going down. Yeah. I mean, that's like people that do these tax deferred things. Like, well, I'll defer my taxes. Well, how often do taxes go down?
Yeah.
I mean, you know what I'm saying? Like, lock it in. When you get something you love, lock it in. I did want to ask you about one thing quickly because we're running out of time here. Warren Helms, the bow tie guy, shout out to Warren, came out in my office and talked to me a little bit about the bank statement program. And that was extreme. I mean, that's the first time I heard about it. Maybe I've been under a rock. But to me, self-employed, these folks that traditionally would not be able to go out and get a home, buy a home, that to me is a really cool program. So explain how that works.
Let me tell you how awesome this program is. It's really as simply as if you are a owner of a business and you are self-employed. So in his case, the loan that he's currently working on, his borrowers are self-employed. We had to collect 12 months worth of bank statements. We take the income deposits that are business-related deposits. We tally that up by the month. We take the 12 months worth of statements, average all that by 12. That's the income we give them. So it's as simple as what their income is coming into the business is all that we're basing it on. What typically happens in self-employed borrowers, and I know most of you listening are gonna find this out, self-employed is historically notorious for having a Schedule C on their taxes, which every bit of that money that you typically are deducting, yes, it is saving you money. The problem is it's also a nightmare for a lender to try to get around, because the only things that we can typically give you back credit for is depreciation and other small items that we can give credit for. So the bank statement program really steps in, really takes the whole tax return variable out.
So you don't have to provide any tax documentation, just bank statement.
It's 12 months.
What
bank
kind of down
statements.
payment comes with that loan?
With that, right now they have a 15% down
Okay,
payment.
so it's not
So
crazy.
it's not. But on that, it's a non-qualified loan. So that means that there is no private mortgage insurance that's incorporated with it. On that particular loan as well, if you are not self-employed and if you are a company, you can do 24 months bank statements. So, there are different ways that you can do it depending on how you're structured and how your bank statements are structured. It can be between a 12 and a 24-month program. But what we're finding and what the realtors that we're working with on this program are finding is there is a big gap in the market, and this is filling that gap.
I love it.
Yeah, every entrepreneur should love that.
Absolutely.
As someone who has not been a W-2 employee for 30 years,
right.
A lot of times it's hard, even though you're making good money, it's hard to prove it.
Right.
So that kind of program,
Because
I think is really,
the reality
really
is if we're being honest, you don't want to.
when you're in business, your goal is to show a loss.
That's a fact.
So yeah.
It makes a lot of sense
It
for me.
does.
Just the IRS doesn't.
Hey guys, we believe it or not, we're out of time. We've been talking for 30 minutes. Most of that was good stuff this week. Last week we talked about baseball team.
Nice.
Hey, go Trash Pandas.
Yeah, Stephen Allen has been our guest today. He is with the mortgage firm. How do folks get in touch with you?
You can go online at themortgagefirm.com/Huntsville. Or if you want to give us a call here in town, we are 256-705-FIRM. So again, 256-705.
We'll have to have you back because this is a topic you really can't cover in 30 minutes. Zach, what you got shaking? Anything? Careful.
No comment.
No comment. All right. Hey, don't forget to check out our website, revolved.com. You can take a look at all of our listings. You can search for over 3,000 homes, I think, in our database now. We can do a CMA for you. Anything we can do for you when it comes to buying or selling real estate, we are your guys, believe it or not. So, hey, this has been fun. If you've been on the live feed, we appreciate it. We appreciate your questions and comments. If you're watching on the replay and you have a question or comment, just drop it in below and we will get Stephen to answer that for you. All right? That's it, guys.
Thanks, guys.
Say goodbye.